Good morning and welcome to our weekly edition of Ashworth, our Ashworth Weekly Market Update. We welcome you today. We're grateful for those who came last week to our food truck event. We had just a 2-hour window, 3-hour window of no snow, and we had a lot of people come, and we appreciate your support on that. It's great to see everyone. With this week's webinar, we're going to take a look at asset class returns and what happened during the first quarter. Some interesting things have kind of shaped up, and anyway, we actually got some positive returns this quarter, and in some parts, some fairly significant returns, which was nice. And let's just kind of break it down real quick. What you'll see here is this. This is domestic equity. But primarily is dealing with international. 8.6 was the highest return asset class that we had last quarter. Most of that was due to the fact that European stocks had been beat up so much with everything that was going on there in the Eurozone that they were able to make a fairly good run this quarter. Followed just right behind them was U.S. large equity, 7.5%. And you'll notice the difference here of what I want. One of the things that I want to highlight here is we've got 7.6 for large cap. If we come over here to small cap, you'll notice that we have 2.7. The primary difference between this is that the large cap is fairly heavily dominated by tech companies, and the small cap is fairly heavily dominated by financials, banks, and those type of things. So with the banking crisis, a small cap took a little bit of a hit, actually not a hit, but didn't return quite as much as the rest of the market did. And most of the financials that we were looking at and that we've been tracking, most of them have been playing defense for quite a while. And so they were already, they were locked and loaded and ready to go as soon as the market kind of turned and were able to take advantage of a little bit of a softer tone from the Fed, as they didn't reduce or they didn't increase interest rates quite as quickly as we had anticipated that they would. Emerging markets here at 4%, that's primarily due to China opening up from their COVID policy. And then you can see that even fixed income, we had a 3% return on fixed income. Again, we've been saying for a while that we felt like that fixed income probably was going to treat us fairly decently this year from an asset class. Most of the yields that we have in the fixed income right now are in the 3, 4, 5% range. And if interest rates even go up just a little bit, that rate will be absorbed by the interest rates. And as interest rates start coming back down, we should see some additional principal appreciation on those fixed income. Global high yield was about in the same ballpark. Real estates for REITs got a little bit of gain, up about 1.5%, primarily just due their struggle this year so far has just been the increase in interest rates and the lower demand that we've had on real estate. So again, a diversified portfolio has been helping us, with an overweight in large cap has been helping us, and it looks like the markets are beginning to heal. We've got had another good week last week, and we anticipate continued volatility in the marketplace just because we don't quite know what the Fed is going to do here going forward. The biggest struggle that they've got right now is to understand how much restrictiveness that the banking system is putting onto the economy, and then trying to adjust interest rates accordingly. We anticipate we'll probably have another interest rate increase before the end of the year, but we don't know what's going to happen beyond that. So again, we expect continued volatility. Just people are assuming things, and as those things either do or do not materialize, we have these jumps in the market, both up and down. But we feel like that as we have stayed in the marketplace and stayed invested, we have been able to gain quite a bit back from what we had lost last year in the marketplace, and the buy and hold strategy seems to be working. And just stay tuned, be patient, and we will help you through it the very best we can. With that, thank you for tuning in today, and we will catch you next week on another edition of our weekly market update. Thank you so much.